So let's get started. My name is Elizabeth Aloni, and I am with Schneps Media. We are the largest media company in New York City with over 70 newspapers, magazines, websites, webinars, podcasts, and events across Queens, Brooklyn, the Bronx, Manhattan, Long Island, Westchester, and Philadelphia. Today, we're thrilled to have Jay Mota, Financial Planner, with us to talk about challenges that impact your financial life. I'd like to tell you a little bit about Jay. Jay is proudly married with 2 daughters and 2 sons. He was born and raised in the Bronx. After high school, he enlisted with the U.S. Marines and later, again, served the Army National Guard. His career in financial services began in 1997. He studied financial services at NYU and has a degree in business. Athletically, he ran the New York City, Chicago, Boston, and Marine Corps marathons. It's his mission to be a resource, to create value in the lives of others. He's continuously working to improve himself so that he can help as many people as possible in all areas. He's disciplined and governed by his principles. His clients work with him because he takes the time to educate them about planning for their financial needs and concerns, whether it's saving money, getting ready to retire, or discussing insurance. It's his objective to help his clients prepare for whatever may happen in their lives. Ultimately, he works with his clients as a resource to fulfill their needs and expectations. His own agenda is not a part of that. He is committed to his practice. Recently, he was awarded the #1 financial services representative in the country for 2 consecutive years, otherwise always finishing with the top 1 percentile. He's been published as a columnist regarding financial matters, and outside of his professional work, he was recognized nationally for his involvement in the community. The Building Blacks Foundation is a nonprofit he started that serves the homeless youth attending New York City public schools. It is my honor to introduce you to Jay Mota and to let him take it away and provide you with this valuable information. Thanks so much for being here, Jay.
Thank you, and I thank you very much for that very generous introduction. I thank everyone for joining us today. I am not sure where you all are located. I would assume that you're somewhere in the New York metropolitan area, perhaps the tri-state area, but just to give you a heads up, where I am, I live in northern Jersey, and it is pretty dark outside. So I have a contingency plan, but if I should go away due to an internet break or loss of power, please do not sign off. I will come back on via backup. So it may be a brief interruption, but I will come back on, and I just want to let everybody know that just in case there's an interruption with the service. The other thing I want to share with you is that this is a very high view conversation. I do a lot of discussions when it comes to financial services, and I do a lot of webinars now since the COVID and the change of how we deliver our information. And some of the feedback that I get back was, well, it didn't go too much into detail, etc. I'm going to go into detail, and I'm going to give you examples, and I'm going to do my best, and I think you're going to really enjoy the information. However, understand that there's a lot of people on today's webinar, and with that being said, me being in this business for decades, having worked with thousands of clients, I don't ever recall working with 2 clients that were exactly the same. So everybody has unique needs. This is also why it's important that you focus on your financial goals and your financial planning specifically, and not necessarily do what other people do or take advice from other people that don't know your personal situation. So just understand that I'm going to go through a high view. We're going to touch on a lot of points. I want to leave time for questions, and I want to try to address everyone's questions. However, I am a financial planner here in the New York, New Jersey, Connecticut area, and I do have a full comprehensive financial planning team with dedicated specialists in different areas of financial planning. I kind of oversee the whole operation, and I work with a lot of clients myself. But if there's something that I can't help you with, I do have an expert on my team that can. So just keep that in mind, and you're always welcome to reach out to me or your financial professional if you have any questions regarding today's presentation or anything that we touch on. Just know that for compliance reasons, I really can't get specific into your particular needs. And I can't really give advice over these types of events. When I say advice, I mean specific advice. But let's get into it. I don't want to give you too much to expect. I want to get into the presentation and let you judge for yourself. But I do believe you're going to enjoy the information that we are going to go through today. So let's look at life's challenges. You know, throughout our lives, depending on where you are in your life, there are going to be different things that you're going to be focused on, whether that's buying a house, growing a family, paying for education, caring for your parents, your own retirement, you know, being alone, losing a loved one, and then if you pass away or when we pass away, leaving money behind. The choices we have to make in life: income, how much do you want? And how much do you want to make? And how much will you save of that? Your possessions. On a home, do you want to own or rent? A car, do you buy or lease? And what do you spend your money on? And your debt. How much debt do you have? And are you comfortable with that kind of debt? Do you understand the different types of debt? You know, financial goals change based upon generations. And millennials who were born between 1979 and 2000 are probably looking at starting a family, paying off student debt right now. Gen Xers who were born in 1965 to 1978, they may be buying homes, paying for tuition for their children, and really looking at their own financial security. They should be in their stride by now. Baby boomers, born in 1946 to 1964, I think they're predominantly looking at retirement and focusing on what their retirement's going to look like, how much money they're going to have in retirement, what kind of lifestyle they're going to be able to live in retirement based upon the years of savings that they had. And the mature generation, those are folks born 1909 to 1945. And I think that generation, you know, the planning is done. There's not much planning they can do to get to where they are because they already lived it. Now they're thinking about, well, how are they going to leave it behind? And what's the best methods to leave behind a legacy or whatever kind of estate they have accrued over their lifetime. So let's talk about how do you grow your money? And this is a really easy way to kind of gauge more or less how you can grow your money. It's the rule of 72. And the rule of 72 means if you divide 72 by the average rate of return, that should tell you more or less how long it'll take to double your money. So a quick example of this is if you invest $1,000 and you're going to earn 8%, in 9 years, you'll double your money, right? So you'll have $2,000. In 18 years, that $1,000 will be worth $4,000. And in 36 years, that'll be worth $16,000. Now, that's assuming a consistent rate or average rate of return of 8% and investing just $1,000. So why is this important? Well, if you don't know where you're going, how do you anticipate getting there? And if you don't know what your retirement is going to be or what you're going to need in retirement, then what are you saving towards? If you don't know what college is going to cost, how are you saving for college? Or any financial goal, or any goal in that, for that matter. So when you want to take a look at your financial goals, you have to determine how much you need. Then you have to determine how you're going to get there. And that's going to really dictate how you invest your money. But when you think about how much time you have and how much money you have to save, if you thought to yourself, well, I'm a very risky guy, so maybe, or a girl, you're going to get a higher interest rate return average, potentially lose. There's a lot of volatility. If you're conservative, maybe you're going to earn a little interest. Maybe you only earn 4% interest because you're taking conservative type of investment approaches. So these are all things that you need to consider. But a good rule of thumb is rule of 72. And that's going to help you to determine how long it'll take you to double your money. And that's not considering consistent contributions. In other words, if you make $1,000 today and you did nothing more, then that's what you would multiply, right? So you would say $1,000 today, 8%, therefore 9 years would be worth $2,000, et cetera, on 18 years, et cetera. But if you're making contributions continually, it's a little bit more difficult, and I recommend using a calculator. But this is a good way just to get an idea. So how do you invest? Let me ask all of you, How many different accounts do you have? And do you understand all of the holdings in your accounts? In other words, you may have an IRA from an old job that you rolled over a 401k. You may have multiple 401ks. You may have a brokerage account online. You may have something through your bank, but you may have multiple accounts. If you're a little bit older and you live life a little bit and you've accrued some money, you may have invested in different areas. And the sad part is that when I've reviewed statements from my clients, they don't understand the holdings that are in their investments. And that could lead to a lot of problems because diversification is one of the key factors to investing. When you diversify, you have money in different areas. You have an understanding of risk and how it's going to counteract certain type of risks in the market. And then it's going to help to preserve some of your growth. So let's look at the first example in the upper left-hand corner, someone who's not diversified. Someone who's not diversified, they have money in savings or CDs or checking account. There's no risk to it. But the growth potential is really minimal to none because they are not taking any risk, right? That term, high risk, high reward, that comes into play. So if someone's not diversified and have all their money in cash or sitting under their pillow, they're not going to experience any risk, but they're really not going to get any growth. In fact, when we calculate and look at growth in financial world, we calculate about a 3% rate of inflation. And that's because since 1913 until today, the average rate of inflation is just north of 3%. So not every year are you going to have a 3% inflation, but we calculate for that. So that means that if you have $100 sitting in the bank account, not earning any interest, next year conceivably it'll buy you $97 worth of goods. And every year that you keep it, we talked about the rule of 72 and how compounding growth is beneficial. Well, if you are not earning that, well, you're losing at a compounded rate because every year that 3% is compounding. So the adverse would happen. And therefore, you could significantly lose purchasing power. And so you think you're saving money and you're not taking risk, but in reality, you're losing 3% conceivably every single year that you're not invested in something that's at least earning something to maintain pace with inflation. So the next person that's at the bottom left, this person has high risk. They're 100% into stocks. Well, they have high risk because the market, especially with the pandemic going on and all of the politics that are going on and everything that's going on in the world, there's a lot of volatility. And, you can listen to analysts, and I read white paper and I look at the Financial Times and I listen to, different analysts every day as I get information from my clients. And it's amazing how hypocritical they are because today they say one thing, tomorrow they change their tune, the next day they change their tune. And really it's hard to predict where this market is going. There are a lot of opinions out there of how the market is reacting to what we're facing in the world and where we see the market going. When COVID occurred, they said there's no way we're going to have a V recovery. There's no way the stocks are going to come up. And in fact, guess what? The market kind of rebounded in that fashion. Although not completely, but we did see almost an immediate return after we hit the bottom. And they thought it was just going to be flat, and that's not what we saw. But we're seeing more and more volatility in the experts. They really don't know, and therefore, everybody speculates. And when you have 100% of your money in stock, that's a lot of risk. So diversifying your portfolio is very important. And if you have multiple accounts, such as a 401k or IRA or brokerage account, what have you. If you don't know what you're holding, you may think because you have a Fidelity account with Fidelity funds in it, and you have, let's say, a Goldman Sachs, or if you have a Bank of America, or whoever you have with individual funds, you may think because the fund has, and we'll talk about mutual funds, but you may think because the investment has a different name, it's something different. But the reality is that the underlying investments may be exactly the same. So therefore, you're not really diversified. You have different accounts with different names, but the underlying investments are the same. So understanding that is really key. And that could be a challenge to growing your money Because if you're not diversified, if you have all your eggs in one basket and that particular basket is not doing well, well, guess what? The chances of you losing money are more significant than if you can leverage that by diversifying that risk. Another big part of investments is deciding on whether to pay tax now or pay tax later. And the reality is that everyone is different, as I mentioned earlier, and understanding where you are in life and how that's going to affect you now or later is a big decision. So most of us are accustomed to putting money aside for retirement before tax. So at work, they offer you a 401k or 403b, or you have an IRA that you're doing on your own, and you're putting money aside, and either you're getting that as a deduction on your annual income, or your employer is taking that money out and putting it aside for you before they decide what you owe in taxes, right? So if you make, let's give you a hypothetical here. If you make $1,000 a week and your contribution is $100 per week, then you're only getting taxed on $900. And that $100 is going into a before tax account, which is great, and that's fine. But the reality is you have to think about, is it better to pay tax today or pay tax later on? So let's look back about 40 years in the 1970s when there were 26 different tax brackets, and the highest tax bracket was as high as 94%. Today, we're at we are at the lowest tax brackets and percentages that this country has seen. So right now, you may be deferring tax on a very low percentage. And if you're here, if 1970s was here, and now we're here, well, if you've got 20 or 30 years before retirement, where are taxes going to go? So you got to consider, what do you think taxes are going to do over the long term? Is it better to defer taxes today and then pay taxes in retirement? Or is it better to pay taxes now at a low rate that you know, and then you don't have to worry about taxes when you retire? So diversification will help you with risk. But tax, what you keep is what really matters, right? It's not what you earn, it's what you keep. So you can do phenomenal in your investments over the long haul. But if taxes go up, taxes are going to erode that growth. And when you have a or a qualified account and you're not paying taxes today, you're deferring taxes, you're not paying taxes on any of that growth, and you're not paying taxes on those contributions. You're not paying taxes on contributions your employers make. But all of that money is growing. And we talked about compounding and the rule of 72 and how fast money compounds. So if you're 30-something years old or 40-something years old with 30 or 20 years to retirement, and you have a lot of time to grow, all of that growth will be taxable when you retire. At what rate, we don't know. And no one can tell you that. You just have to think for yourself. Do you want to be subjected to the potential of paying a much higher tax? So that's something you need to consider when you're making your contributions. Now, non-tax deferred, that's your money that you're putting in to your online brokerage accounts or through your investment banker or through a financial planner, and you have your accounts. Those you can't do anything about. You're going to pay tax on them, whether you're paying tax on interest, dividends, the gains. There's going to be capital gains tax, short-term, long-term. That you really can't control. Ordinary income tax and dividends and things of that nature. But when you come to your retirement, your long-term, you have tax-deferred growth, whether you put money in before taxes or after taxes, that's something you need to consider. But even with your taxable accounts, understanding the type of investment you make. For an example, if you're in an income fund, if you're in a mutual fund, or if you have a dividend-paying stock, you can anticipate paying taxes because you're going to see growth, but you're also going to get payments. You're also going to have income. So understanding what type of investments you're making in your non-tax deferred accounts, and your brokerage accounts, and your non-retirement accounts, or your non-educational accounts, understanding the type of investments you have there could also impact you. Because if you're paying tax every single year, it could be diminishing how much you're earning and what your reinvestment rate is. Because if you're paying tax, well, you have less money to reinvest because the income you're receiving, you're paying tax and you're reinvesting the proceeds. So understanding this is very important. And obviously, this is something you have to go over more in detail with your planner, with your plan in general. So, investment management. A lot of folks that I speak with at one point in time did it for themselves, right? How do you make decisions in your 401k? I mean, the scariest answer is, well, my coworker said that that's what they do and I do the same thing. That's the scariest answer. And unfortunately, the water cooler recommendations is all too common. And oftentimes our parents or, it's like the herding mentality where other people do it, so you do it too because it worked for them, it may work for you. Certainly not saying that everyone on this webinar is doing that, but it is a very common instance when it comes to making decisions that people do what other people do because it works for them. And keep in mind, they may not be educated on what they need to do for themselves, and yet they're making decisions, and now you're following those decisions. Ultimately, could be bad. But if you're managing your investments, I'm gonna say it, but I don't want it to come across like I'm telling you need to hire somebody to do it for you. But it is known that if you hire a professional to manage your investments, you will outperform if you do it for yourself. Unless you do it for a living, and unless you are constantly reading the news and making decisions and making changes and adapting to the market, it's very challenging. It's very challenging to manage your own investments. Truth be told, I'm so busy that I can't manage my own investments because I can't sit there and watch all day what's going on. So I have investment specialists on my team that review my investments because that's what they do all day. But making a plan, understanding how the plan is going to affect you, knowing what type of investments you have, and then managing those investments and helping you with the decisions. Another factor about hiring management, and the one thing that I benefit from, because we're all susceptible to it, is our emotions. When you're managing your own money and you see the market going down, you panic. You may make an irrational decision. That may not be the best decision to make. But when you add a buffer, like if I'm concerned about something, I call up my investment specialist on my team and I ask them, hey, what do you think about this? Are you worried about it? Because you know what? It just takes the pressure off of me. And I think that a lot of people who I speak to who do it themselves, I'll say, hey, how you doing? Oh, I sold that investment last week. Well, why'd you sell it? Oh, because it went down. Yeah, but it went back up the day after. Did you consider that? So understanding what your plan is, but hiring a professional really takes the emotion out of it. And I would say making decisions based on emotions, it'll take that out of it. Mutual funds are very common. Most of you probably have mutual funds in your IRAs or your 401ks. They're a great tool for investments because they allow you to diversify. But as I mentioned earlier, understanding what your mutual funds consist of, because you may have a mutual fund from American Funds, you may have one from BlackRock, you may have one from Fidelity, Vanguard. I can go on and on and on with thousands of names of mutual funds, and they all have their own name. And yet the underlying investments in there could all be the same. So understanding what type of mutual funds you have, understanding the correlation with the other ones, and and diversifying that portfolio is key. If you look at it, you have money market, bond, balance is a combination of investment or stocks and bonds, growth in income, large company stock, small company stock, aggressive growth stock, international stock. So this chart kind of tells you, the potential return. So the international stock has the greatest amount of return. Why is that? Well, because conceivably it has the greatest amount of risk. Why? You have all kinds of risks when you're dealing with international stocks. You have your own government, you have foreign government, you talk about tariffs, you talk about treaties, you talk about all kinds of things. You talk about COVID. Try to get anything imported these days. It's so far behind because people aren't importing goods because of the COVID. But understanding this is extremely important and diversifying your portfolio. So when you're doing your 401k and you have an IRA or you have mutual funds elsewhere, you want to make sure that you're diversified and understanding how much risk is in these mutual funds, what the underlying investments are. And I just want to tell you, if you don't understand, a mutual fund is a pool. So what a mutual fund does is you have a team of professionals that manage this fund. And in this fund, they put multiple types of investments. So if it's a bond, a mutual fund, a bond fund, then it's all different types of bonds. Well, are they long-term bonds, short-term bonds? Are they high-yield bonds? What type of bonds on there? What kind of risk are involved with those bonds? That's important to know. Balanced, bonds and stocks. Growth, companies that reinvest their money and put money into research and development. Large company stocks, your mega blue chip companies. Small company stocks, startups, the companies you find on the Russell 2000. Aggressive growth stocks, and again, we talked about international stocks. So understanding each type of these funds, they can have thousands of stocks in them. You can see, if you pull up the name of your fund, I like to use Yahoo Finance for my own personal tool, but you can see what's inside of them, and you can also, so you know, well, listen, if this fund has Ford Motor Company, Coca-Cola, Facebook, IBM, etc., and I have this type of mutual fund, well, guess what? It may have the similar type of investments. Is that safe? You're putting all your eggs in one basket. It may not be a good idea, okay? There's a lot of things to know about mutual funds. Mutual funds come with fees because they are managed. So the cost of a mutual fund, there are different types of ownership of mutual funds, and every type of ownership of mutual fund has a different fee structure. So mutual funds are very easy because they also offer diversification and they offer management, but it could be expensive. And if you're not diversified, you could be misled. Annuities, do they make sense for you? So there's a lot of bad talk about annuities, and the reality is it drives me out of my mind when I hear people talk badly about annuities. Now, I'm not going to tell you that an annuity is for everyone, but there are different types of annuities, and there are people out there that want to acquire your money so that they can manage it for a percentage. And that's not a bad idea. But what I don't like is that they automatically shoot down annuities. And the reality is that annuities offer a death benefit. So the good thing about an annuity is if you put money into an annuity and later on pass away, your family is going to get at least what you put into it, unless you've taken any withdrawals. Then they're going to get the net amount of what you put into it less what you withdrew. Right? That's a death benefit in an annuity. If you lost money in an annuity because of investment performance, that typically doesn't affect the death benefit. Now, it's not 100%, but typically doesn't affect the death benefit. So that means that if you retire and you put all your money, not that you should put all your money into an annuity, but you put money into an annuity, well, guess what? If the market tanks, your family could be saved by an annuity, because despite the failure of the market or despite the losses in the market, your family won't experience those losses. So there's protection. Annuities are actually a life insurance contract, and maybe many people don't realize that, and that's why only life insurance companies can sell annuities. But there are good annuities, and there's time to make sense of annuities, but there are times where people should not be buying an annuity and are sold annuities. So don't automatically throw out the idea, but don't automatically jump into it, because there are a lot of different benefits out there that are sold. And if you don't understand the type of annuity you're purchasing, you could be putting yourself into a situation that can be very costly and difficult to deal with, right? But there are fixed annuities that offer a fixed rate of interest. Right now, they're very low because interest rates are very low. But if you're looking for like a CD type of account that has a life insurance component to it, you have a fixed annuity. I don't know if that's the right thing to do. There are different types of fixed annuities, but there are variable annuities. There are annuities that guarantee income for life. There are annuities that just give growth. The guarantee for income type of annuity, you can lose money in there, but you may have a guarantee of income. And there's many of them that work in many different ways. There's annuities that provide growth with no guarantees, but it's important you understand that your situation will dictate what products are best for you. And if you work with an honest fiduciary financial professional, they're going to tell you what makes sense. All of your money shouldn't go into an annuity, and you shouldn't automatically buy an annuity. It should make sense for you, and there should be a reason for it. So that's what I want to talk about annuities. Understand annuities have fees. There's management fees, there's fees for features, there's fees for the death benefit. So you want to compare those fees as opposed to other types of investments. So there's a lot to know about annuities, but it is a good way in retirement to help protect and provide income. The other thing I'm going to mention about annuities is that, you know, you really shouldn't be buying an annuity if you're not over 45-ish, maybe 50, because all annuities offer deferred growth. We talked about putting money into investments that are not taxed or taxable or not taxable. So when you put money into an annuity outside of a retirement account, even in a retirement account, if you put money into an annuity, the growth of that annuity is deferred. So that's great. So you're not paying annual tax on its growth. But there are surrender charges, usually 7 to 9 years, and typically you can't take the money out before 59 and a half without a penalty. So they give you the growth like a retirement would without paying taxes annually. And that's whether it's retirement or not retirement, you're not going to pay growth on the taxes. But if you took any money from that annuity before 59 and a half, you will be penalized. So it is important to know that if you're buying an annuity, you want to be at an age where you may not need that money, or you're close enough to 59 and a half where, you know, if you're 50, okay. If you're 55, even better. You want to be close enough to 59 and a half so you don't have to wait for a long time. Children should not be in an annuity because they have to wait to 50. It's just, there's a product for everyone and there's a plan for everyone, but just understand this is a high view, and don't automatically turn off annuities, but don't automatically turn to them. So how do we protect what matters most? Let's talk about protection, right? And what I'll say is, when it comes to protection, it's insurance, all types of insurance. And no one really likes insurance, and I sell a lot of insurance, and no one likes insurance until they need it, right? No one wants to buy life insurance, but God forbid they pass away. Typically, I'm one of the top 5 people that they call when something happens, right? My property and casualty team, I have a full team of people that handle home and auto insurance, right? They don't want to be called about their home and auto insurance, but guess what? If they get into an accident, we're generally, and no one's hurt. If someone's hurt, it's 911. But if no one's hurt, we're the first one they call. If something happens to their house, I'm going through a storm right now. If trees fall on someone's house, who's the first person they're going to call? Their insurance company. So no one likes to deal with insurance until they need it. So it's important that you understand it, right? So what type of insurance protects your house or your car? That's property and casualty insurance. Your assets when you retire, long-term care insurance. Your paycheck, you have disability insurance. And your family, life insurance. So it's important to look at these different types of ways to protect yourself and your family and your property. Life insurance, there are 2 different types. You have term insurance, you have permanent insurance. There's a pros and cons to both. One is owning, the other one's renting. You know, the question I ask folks that have term insurance, it's cheap, I understand. You can get a higher amount of insurance for a very low premium. There are a lot of companies that we offer insurance through, and they all have their pros and cons. But if you're 30-something years old or 40-something years old and you're buying yourself a 20 or 30-year term, when that term period is up, what do? Right? Life insurance is based on your health and your age. So as you get older, life insurance inevitably is going to get more expensive. If you're no longer as healthy as you were when you were 25 years old or 30 years old, you may not even qualify. Or if you do, it could be at a higher premium. So just understand, when you buy term insurance, it can sometimes lead to a false sense of confidence because, yeah, I'm covered and I'll worry about it tomorrow. And then those clients that I've worked with that are 55, 60 years old who had a $500,000 life insurance policy that was term, and now they're 55 or 60 and that policy is coming to an end and they're looking to replace that insurance, it's a huge sticker shock because they don't realize the cost of insurance and the significant difference in cost of a policy when you're at that age. So if you have a term policy, it's not bad, and there's good reasons to have term insurance, but just understand, don't get that false sense of confidence. Permanent insurance, meant to last you for the rest of your life. There are a lot of different types of permanent insurance. I argue all the time that permanent insurance is cheaper than term insurance because with permanent insurance, generally there's some kind of cash value savings inside that accrues. And if you look at what you paid into a permanent insurance with the accrual of cash value inside that policy and the net expense, so I paid into the policy, I give you a hypothetical over 20 years, I paid $20,000 into a policy, but I have $18,000, $19,000, $20,000 in cash value. What did that cost me? Cost me maybe a couple $1,000s. But if I have a term policy and the term policy ends in 20 years, what do I have to show for it? Nothing. So therefore, term could be a lot more expensive, right? It's just today or tomorrow. When do you want to pay? So just understand the difference between the two. And if you don't have life insurance, it's a good time to look into it. And if you do have life insurance, it's a good time to review it and make sure that you're not setting yourself up for a future failure. Life insurance comes with different types of riders. You have waiver of premium, which means that if you get injured and you're on disability, you no longer have to pay your premiums. Accidental death, if you die from an accident, typically there's an enhanced death benefit. You can add your children as riders to it, so you can cover your children. I know that's a sensitive topic, but it could be beneficial for your children. And living benefits. Most people don't realize that if you have life insurance and you're diagnosed with a terminal illness, you can get an advance of your life insurance if you're provided, if you're given less than 12 months to live. And every company has different amounts. But I actually have a story about a client whose life was saved. And real quick, the story goes, gentleman had a rare form of throat cancer, was self-employed. He had life insurance, and the doctor said to him, well, listen, you have to get this surgery. It's experimental, but that's the only thing I think can save your life. Well, his health insurance company wouldn't pay for it because it was an experimental procedure. Well, the argument between me and the insurance company was, he's got a sentence to die because if he doesn't have the surgery, he's going to die in 6 to 7 months per his doctor. And the insurance company said, yeah, well, he can get the surgery. And I said, well, he doesn't have the financial means to get the surgery. Long story short, he got his death benefit paid out. He had the surgery and he's alive today with his family in Texas. And we talk every so often. And it's one of the most profound stories of my career that this gentleman's life was saved by his own life insurance policy. So there is living benefits to life insurance, and that's a true story. Homeowners insurance, auto insurance, commercial insurance. Here's what I'm going to say about insurance, because I want to leave enough time for questions and answers. I would put money down that 90% of the people I speak to initially are way underinsured. And this is the question I'm going to pose to you. If you don't know what you have in automobile coverage, and this is real easy, you don't know, because everyone in New York needs by law, most states have a law where you have to have automobile insurance, at least to pay for the other person's damages, right, and medical expenses. Let's just say you have $50,000 in coverage, 25, 50. Let's say you have 100,000, 300,000 in coverage. And you're driving on 287, or you're driving on the thruway, wherever you're driving, you're going out to the beach on the weekends in Long Island, or you're going to the Jersey Shore, and there's traffic, and you get into an accident, and multiple cars are involved, people are injured, and you're found responsible, whether you did it because of negligence or because you did it because it's an accident. That's why they call it an accident. But now you're found responsible for the entire accident. And that accident cost $1 million, all set. Do you think the attorneys for the other parties are going to say, well, they only had $300,000 in insurance, so we'll take the $300,000, we'll be happy? Not going to happen. What's going to happen is they're going to sue you for the rest. And if you don't have adequate insurance, that's going to be a judgment against you. It's going to go on your credit. And you're probably, unless you can write a check for the remaining balance, which if you could, still stinks because you just lost all that money that you've been saving up that was probably geared to something else. But most people are not going to be able to write that check. And so they're going to have this dark cloud over their head. And here's the other thing I'm going to tell you about homeowners and auto insurance and commercial insurance is that the difference between minimal coverage to good coverage and the right coverage is usually not a lot of money. It's surprising, but there are so many people that are focused on price because they have to have it, and everybody hates to buy insurance. I don't know anybody that loves to buy insurance, but they don't want to spend money on it. And therefore, something happens and they're not properly covered. And I'm telling you that, think about it. Do you want to pay an extra few $100s a year to protect yourself from potentially having to fork over $500,000 or $1 million in a lawsuit? Think about that the next time you're looking at your insurance coverage. And do you understand what your insurance coverage is going to cover? Or do you want to wait till an accident occurs to find out that you're not properly protected and now the rest of your life could be altered? Just food for thought. But many people don't know what coverages they have, and it's very important that you do know. The other type of insurance we're going to talk about real quick is long-term care. Things I want to talk about this. Long-term care is asset preservation and dignity preservation at death. It pretty much provides care for you at home or in a nursing home. If you're a person that is in, pre-retirement, retirement ages, this is something you may want to look at and speak to either myself, someone on my team, or your financial professional, and understand whether or not this makes sense. But, most cases, Social Security provides for it. But if you have assets, maybe some of you have had family members that have had to spend down their assets in order to get Medicaid, which is Social Security, to provide this service because it's not covered by Medicare and it's not covered by health insurance. It can get very costly and therefore can deplete assets and make your life miserable. And if anybody's been through it, you understand the Medicaid spend down is a horrible experience where they basically make you go broke before the government will help you. So understand that long-term care insurance is a particular insurance that provides you care or nursing home care. You have to qualify for it, but it could save a lot of money and preservation. And for those of you that have elder parents that you don't want to change their diaper or give them baths or worry about taking care of them, this may be something you want to think about for your parents. Disability insurance, paycheck protection. What's important about disability insurance? There are two types of disability insurance. You have short-term and long-term. Short-term usually lasts up to 2 years. Most of you get it through work. You have long-term, which can last you up to 65. It's usually a minimum of 5 years up to age 65. There are some plans that go longer, but short-term usually only covers 2 years. So you got to know what you have. You got to make sure you're covered, because if you're not getting a paycheck, how are you going to pay your bills? You also want to know how long you have to wait until the money kicks in. You want to know how long it's going to last. We just mentioned that. Here's another thing you need to know. Your own occupation or any occupation. A lot of disability policies will say, hey, if you can't be an architect for 2 years, we'll pay you a percentage of your income. But after 2 years, we expect you to get any job possible, and we're only going to pay you the difference. And there's also Social Security. If Social Security is paying, then your disability paycheck may go down because now you're getting Social Security. So understanding your disability plan, if you don't, you need to have a conversation with myself, the team, or someone that you work with as a financial planner. So look, a plan is evolving. No matter where you are financially, okay, you should have a blueprint of what your financial plan is. I don't care if you have a little money or a lot of money, you got to have a plan of where your financial goals are and where you want to be. You should have contingencies put in place, because as plans happen, seldom do they happen the way we want them to happen. So you should have contingency plans. And most importantly, put a team together for you. Have a team of professionals that can work for you to help you achieve your goals. It's well worth the time spent, well worth the money spent, and it'll help you to prevent from a lot of headaches. So I want to open it up for questions. We have about, 15 minutes or so, maybe a little bit more. I see we got a lot of questions in, so we'll let Elizabeth read them off. And
Jay, thank you. Wow, what incredible information, Jay. Thank you so much. And I want to jump to the questions so we can make sure that we get to them.
Sure.
So one of our attendees said, our son is heading to college in 3 weeks.
Yep.
We're concerned about reprioritizing a spending plan and creating real budgets for the rest of our kids who are still in elementary school.
Yeah.
Most of our funds are currently being channeled into our college-bound son.
Yeah.
What do you suggest?
Yeah, so I suggest that we have a personal conversation, or have a personal conversation with a financial planner, but I know you want an answer, so I'm going to give you one, right? I call it the airplane theory. And here's the airplane theory. If you've ever been on a plane, the attendants will say, put your mask on and then worry about small children. So what I'm going to tell you is that it's a noble idea to be able to pay for your children's education. But the reality is that you have to take care of yourself first. So what I would ask you is, what are your financial means for your own retirement and your own security? And, if that's covered, then we can further elaborate, on your other children and their ages and such. Educational costs, we talked about a 3% inflation rate. Education, we inflate 5%. So depending on the ages of your small children and how much and what type of school they're going to go to, Are they going to go to a state level school? They're going to go to Ivy school. There are different types of accounts to grow that money, but depending on the type of account, depending on the type of school and how much time we have, we can help plan for how much money you need to save. But, it's noble to want to pay for your children's education, but you gotta try to figure out if other priorities are met, because if you put all your eggs in one basket, you could spend through it all and then end up with not enough for the other things you need. So it's hard to answer your question without knowing your specific situation, but that's the recommendation I would make.
That's powerful information about helping yourself, putting on your oxygen first.
Yeah.
So next question is, my 19-year-old daughter wants to know what she should be doing in terms of investing or organizing her money in order to be successful in the future. Can she open an IRA? Basically, how to start off at a young age, a little at a time. What would you recommend?
How old is she? I'm sorry?
19.
19. So, the thing about 19 years old is that retirement is, it's a good idea, but let's talk about, I just passed this page, right? Let's look at all the things that she's going to be facing before she retires, right? So, consider what she should be saving for. There are different types of savings, but before she retires, she's going to want to buy a house. She's going to want to buy a car. She's going to want to, have a family and do all of these things. And the reality is that, depending on how much money she makes, will really dictate how much money she should be putting to retirement right now, because there's different buckets that you have to be saving money for. So you need emergency money, you need short-term savings, you need long-term savings. You don't want to be putting all your money into a long-term savings account, especially if you're 19 and you can't touch the money for another 40 years without penalties. So it's important to know how much money you have coming in, what your savings goals are, how much money you need to have an emergency, and then we can allocate money to retirement. But someone who's 19 years old, retirement's kind of at the bottom of the list. So I would say if she's going to open up an IRA, really before you decide how much money she should put in an IRA, you got to decide what other type of financial goals she has, and then it kind of back into the IRA.
Would you recommend a 19-year-old meet with a financial planner as well to start setting up these things?
I would, but when you're at 19 years old, it's very challenging. So every 19-year-old is different. Definitely, I think education is paramount, right? I think understanding, one of the challenges, at least for me anyway, no one spent time explaining financial services to me or financial concerns or whatnot. I had no clue what financial wellness was when I was 19 years old. When I was in my 20s, I had no idea what financial wellness was. I made money, I spent money. I live paycheck to paycheck. It's not until I got a little bit wiser and understood how important it is to manage your funds that it all made sense to me. But, the earlier, the better. I speak to students all the time regarding financial matters, and I think it's important for young people to understand, financial wellness. So absolutely.
Great. Another question came in. Do you recommend an IRA to supplement your work 401k?
Well, a good question. So the answer to that question is, what's your goal, right? So, how old are you? How much do you need in retirement? Most couples don't even talk about retirement. So do you know what your spouse wants in retirement? Do you know what your partner wants in retirement? Have you had that discussion? Do you know what your retirement goals are? If you do know what your retirement goals are, well, then we can talk about how to achieve that. What I will say is that there are income phase outs for IRAs and deductibility, and the IRA types of accounts you can have when you have workplace retirement accounts, and depending on how much income you make. But, 401ks are a great tool because employers generally match. Are you contributing up to the match? Are you taking a full benefit of that? There are other benefits such as loans if you need it, et cetera, hardship withdrawals from 401ks. So, the downside is there's minimal investment options. You're really stuck with the company tells you to invest in. But IRAs offer more diversity, but no one's matching your IRA. IRAs are limited to how much you can put into them. So, there's really pros and cons to both. So, I can't say you should supplement a 401k because I don't know what your retirement goals are. Again, you have to know where you want to be before you can talk about how you're going to get there. And whether or not it makes sense, it may not make sense, or it may make perfect sense. And you may be eligible and you may not be eligible. So that it all depends on the individual.
Great. Another question, is it wise to hire a financial advisor who works for your investment company? I'm assuming this person means the investment company they work at.
You know, I have a lot of clients of mine that work for other firms, and you know, they don't want people knowing their business, etc. If you're alluding to someone who's on my team, and the fact that I have somebody on my team managing my investments, this person works for me. So, I mean, they don't know everything that I own, but I do trust them enough to work with my own assets. Hence the reason why I trust them to work with my clients' assets. But you know, that's a personal preference. I don't think that. You know, I think what's most important is the individual, right? So it's not about where they work. It's more about the individual and their ability to manage money. And do you share values? A lot of my clients that I work with them because I share the same values as they do. You know, when you have a relationship, in order for a relationship to be successful, you have to share the same values. If you and your spouse or you and the person you meet don't have the same values, or people you meet that you're trying to be friends with, if you don't share the same values, there's really nothing there. There's no substance. So this business is a relationship business. And if you don't have the same values or agree on values, then it's not going to be a good working relationship. And unfortunately, there are times where I have to tell clients that, you know, I think that maybe somebody else on my team is better to work with you. So I think it's more about the individual, not necessarily where they work.
Great, thank you for that. You were talking about a lot of investments with fees. One of our attendees wanted to know, are there investments that do not have fees?
Well, so, I mean, listen, there's always going to be money somewhere, but I mean, there are investments that you can buy through online brokerages, like, you know, free stock trades and stuff like that. You know, there are breakpoints that if you invest enough money in an account, you know, there's different levels. If you invest so much money, they may not charge you fees. So, I mean, yeah, there are investments without fees, but I'd be very careful because don't choose investment based on fees. Here's an idea, right? If I charge you 5% fees, but I'm earning you, and this is a hypothetical, right? I'm earning 15% returns for you on a consistent basis, but I'm charging you 5%. You're netting 10% growth. If somebody else charges you 2%, but they're only getting you 6% returns, you're netting 4%. So you want to pay 5% and get 15% return, or do you want to pay 2% and get a 6% return? Where are you earning more money? Again, it's not about how much you make, it's how much you keep. So if you're, you know, depending on the fee structure, and the moral to that answer is that don't judge investments by their fees. Judge investments by how they're going to work for you, and are they going to meet the needs that you have?
Very good thing to think about. Someone wanted to know they had 2 retirement accounts, a principal 401k and a little money in a TIAA CREF from another job. Should this, yep. Okay, thank you. Should she combine the 2, put a smaller amount in the principal account? Is that a rollover? And do you recommend?
Well, if you have 2 401ks, or TIAA CREF is usually like the schools and stuff like that. They're a big credit union for the schools. Unions sometimes use them. Principal is also another big retirement company. You know, these are just companies that are custodians for the accounts. So if you have 2 401ks, if you're working, you have to check your employer and see whether or not they allow you to do that. You know, but, you know, it depends on if you're still working for either of them. And if you're not, you know, are you really getting the help, and what are you paying? Is it better to roll both in an IRA? Honestly speaking, you know, you can combine them if your employer allows to, but again, you know, you should have a conversation with a financial professional so that you can determine what's the right step for you. Because if I say, yeah, roll them together, and your employer says, no, we don't accept outside 401ks, well, then my answer is really not worth it. If you're not working there, it doesn't make a difference because you can't combine them. You have to put them into an IRA. You know, so these are all conversations that you have to have. There's a lot more detail involved.
Great. When diversifying a portfolio, what percentage would you include for real estate versus the stock market?
Can't answer that question. I'm sorry.
Depends, right? Yeah, depends on where they are, right?
Yeah, I mean, you know, everybody has different goals. You know, I can't tell you what to invest in. You know, there are 2 different types of investments. What I'll say is that real estate is not liquid. So, if you're a person that needs liquidity or needs access to cash and you have short-term time horizon, investment's not a good option. If you're a person that has a long time horizon and you don't need the cash, real estate could be a good option. If you're buying in, but real estate, what's the growth in real estate? How slow is that growth going to be in real estate versus investments? If you're a person that has liquidity needs and you need to take cash out, you may need to be in stocks because you may need the money in 2 or 3 years. But there's also more volatility in stocks. So, I can't tell you how much to put towards real estate versus stocks. They're two totally different investments. And what I will say is a good diversified portfolio. If you're a person that has the money to do it, diversifying your portfolio, with stocks and real estate is a good idea. Not only from, a time horizon, return, but also there are tax benefits involved in both. So that's a conversation you have to have, and it's based on individual need.
Great. We have a question here that I think is a great way to end on, which is, during this pandemic, I felt the impact of not having any savings for an emergency. What's the best way to save and invest to prevent this again in the future?
Whoever asked, that's my new favorite person. Here's the thing. We didn't get into it, and we're trying to leave time in an hour. And what I'm going to tell everybody is my phone number's on the screen. You can have a conversation with me. I guarantee you I'm not going to try and sell you something. We can have a conversation and we can go from there. But to answer your question, if you're married and both of you have a steady income equivalent to one another, I would say that you should have at least 3 months in savings for a situation like this. If you're married or you have a domestic partnership, you're living with someone and you have unequal incomes, one makes a lot more than another or one doesn't make any, you should have 6 months inside of a savings account for reserves. If you're single, you should have 3 months. You should know what your fixed expenses are. These fixed expenses are expenses that you know what you need to spend every single month to pay the bills. These are not people going, those expenses are not buying clothes, going to the movies, etc. Not that we can do any of that now, but you should have that money set aside in that time period. And here's another thing. I talked about the airplane theory. I have little nuggets that I picked up and really talked about. It's called the brand new zero. And the brand new zero is this. If you have zero today and you're looking at saving money, let's say you determine my monthly expense is fixed. Monthly expenses are $5,000 a month, hypothetically speaking. And I'm single, I should have $15,000 because I should have 3 months in my account. So how do I get to $15,000 if I'm at zero? That seems pretty difficult to do, and it could be overwhelming and create anxiety and stress, and no one wants to deal with it, right? But what you do is you create a brand new zero every single time. So you start off at zero, you make $1,000. $1,000 becomes your brand new zero. So now you have $1,000 in the bank, but guess what? You really have $0 in the bank because that $1,000 is committed to your goal. Then you get to $5,000 and you have a brand new zero. So $5,000 in your mind means you have no money because your $5,000 is your protection, your security blanket, your safety net. You get to $10,000, $15,000, and what happens is over time, psychologically, your mind, and I do this for myself, and I still do it to this day. I determine how much I want to have in assets, and when I reach that, it's my brand new zero. So I may have whatever I have in assets, but if I have a brand new zero in my mind mentality, I'm broke. So when people say, hey, you want to go away for the weekend? You want to play golf? Listen, I got no money because that's my brand new zero. Now, my sanity is saved because I know I have the money that I want in the account. But psychologically, I know where I want to be. So psychologically, I've created a brand new zero. So what I'd say is set a goal for yourself and set it in attainable chunks. So don't say, I got to save $15,000 a year in a year's time and I make $50,000 a year. It's not going to happen. But set a time period for yourself to save up money so that in the future, if we experience a pandemic like we have and you have a setback, you have that peace of mind. Last little tidbit, I tell my kids, my daughter, my kids are my worst clients because they don't listen to me. And they get my information for free, which drives me crazy. But the conversation I had with my daughter was, I asked her, I said, her name is Kayla. I said, Kayla, let me ask you a question. How do you feel when you get paid from work? She goes, I love it. I feel good. And I said, how do you feel 2 days before you get paid? She goes, I hate it because I have no money. I said, when you have a savings account, every day's a payday. The same way you feel when you get paid and you have money, when you know you have money in savings, God forbid something happens, you have that euphoria because you know every day's a payday because you know you have the money in the account. That's the difference between having money in savings and not having money in savings. Is that feeling of I have no money and I'm getting paid in 2 days and I got to buy groceries, or I just got paid today and I got plenty of money in the bank to pay the bills that I have to pay. So with that note, I guess we're
Love
just
it.
a minute over time.
Well, Jay, I absolutely love that. And the thought about the new zero, this presentation was the absolute opposite of zero. This was phenomenal. You really provided fantastic information, and please feel free to reach out to Jay. His number, 914-565-4287. In the email that you'll get tomorrow, you will also get his number and email address so you can reach out to him. Again, thank you so much for being here, Jay. To all of our attendees, we really appreciate your spending some of your evening with us, and we hope to see you again real soon. Thanks so much, Jay.
I want to thank everybody. Please stay safe and stay cool because it's really warm out there.
Yes, yes. Have a wonderful night, everyone. Bye-bye.